Please welcome Head of Research, Asia Pacific, Nick Axford.
Good morning, everybody. It's lovely to be back. I can say genuinely, this is one occasion where I am very glad to be here. The weather joke's already been done. I have to say, having come from an English summer, I'm not quite sure what all the fuss is about. It's quite a nice day out there. This morning, I'm conscious that we all want to move on and hear about what we're thinking about the Australian market and the market here in Sydney. But I think more than ever, it is important to take a few minutes just to think about what's going on in the rest of the world, because it's having very real impacts on both the occupational and the investment market activity that we're seeing, certainly here in Asia and also here in Australia. I'm not going to dwell on this, because I think if you pick up any paper any day for about the last 3 years, you'll have seen this sort of stuff dominating the headlines. It is quite clear that despite the fact that we're now 4 years into the current crisis in different forms, we are still seeing recurring themes of economic weakness, policy uncertainty, challenges around bank debt, around sovereign debt. A lot of the same themes coming through. Increasingly, I have to say, overlaid in some markets with signs, in some countries, with signs of social instability. I think this is going to be something of a theme in some markets. We need to be aware that a lot of populations are concerned about what's happening, and there's a real sense of injustice and unfairness, whether that's justified or not, but a real sense of that coming through in many countries, certainly in Europe. So we face a very, very uncertain outlook on all sorts of fronts, overlaid with elections going on at the moment, uncertainty around what the outlook for China is, which is clearly a major issue here. And that's feeding through into the uncertainty that we see in occupier activity and behaviour and investor activity and behaviour. Really, I think it's fair to say, pretty much right the way around the world, with some differences and some wrinkles in different places, but nevertheless, the prevailing themes are the same. And I make no apology for reusing a slide I've used a lot in the last couple of years, but just to emphasize that although it's true that growth in China is stronger than elsewhere, although it's true that growth in Asia Pacific as a region as a whole is stronger than we've seen elsewhere, and there's actually been an encouraging, not substantial, but an encouraging improvement in economic performance in various countries around this region. The lower graph does two things. Firstly, it just rebases the axis on which we look at China, and the second thing it does is just strip China statistically out of the rest of Asia Pacific. And I think what's quite clear is that although there is a difference in the magnitude of growth that we're seeing, which this chart tends to minimize a bit, the fundamental picture over the last 10 or 12 years is that the global economic regions continue to move largely in lockstep, and that whilst there is more growth, and Asia Pacific is the bright spot in the global environment at the moment, decoupling to any material extent simply hasn't happened. And I continue to stress that from my perspective, the world is more joined up in investment terms and in occupational terms and in economic terms than it has ever been. And therefore, there are differences in timing and the nature of the impacts, but what's going on in the rest of the world really does matter to this region. We are insulated to some extent, but we are not isolated from what's going on elsewhere. So just to focus very briefly on the two other major regions in the world, this chart shows labour competitiveness of some of the southern European countries versus Germany over the last 10 years or so, really since the introduction of the euro. And whatever you say about the political issues, about debt, a lot of those are political challenges. What is not a political challenge, really, is the fact that southern Europe has fundamentally lost huge amounts of its competitiveness relative to Germany and therefore relative to other parts of the world. Unit labour costs increasing by 30% over the last 10 years or so. They've gone up by about 5% in Germany. And that lack of competitiveness, even aside from a lot of the political challenges, that lack of competitiveness with an inability to devalue their currency is going to place huge strain on the population and it's going to make it very difficult to generate any meaningful growth coming out of Southern Europe. And therefore, a lot of the issues and the problems that we see in Europe are likely to drag on for quite a long time, even if we do get to some more meaningful solution to the bank solvency and government debt crises, which continue to affect the region. From a property point of view, the occupier markets have slowed quite substantially in Europe. Rental growth is patchy, if present at all. It's actually the prime retail sector that's doing best because it's quite defensive. Elsewhere, very, very patchy. Investment activity in the region is inhibited firstly by general investor caution. That's something that's prevalent around the world, and also by a shortage of debt from most sources, banks particularly pulling back their lending. And therefore, what we're seeing is investment activity at a lower level than we've seen previously, and very much focused on those more competitive, those more dynamic economies generally of Northern Europe, plus London. Outside the Eurozone, London is a kind of isolated pool. It's actually held up investment activity quite strongly. And in the first half of this year, 75% of all of the property investment activity that we saw in London was by overseas investors. So a real magnet for international capital because it's a liquid market, it's seen as strong defensively, and therefore one that's proving attractive. Prime values in the UK and in Europe generally holding up pretty well. Secondary values on the slide in most markets because of that caution about the underlying economy. The US, this is also a chart relating to the labour market. I think this tells a very, very important story. This chart shows the trajectory of employment relative to the peak level that it reached through each of the recessions that we've seen over the last 40 years or so. And I think what's quite clear is the magnitude of the impact of the current downturn on US employment is completely unprecedented. And 4 years into the current downturn, we are still nowhere near back to the level of employment that we saw in 2008 in the US. There is an increase in part-time and temporary hirings going on, and corporate profitability is actually very good in many parts of America. So we do expect, once confidence comes back, we do expect a rather sharper trajectory to the recovery in employment terms. But as it stands at the moment, that recovery is pretty weak and pretty limited. And that's very much affecting leasing activity. Interestingly, we have seen just a slight improvement in sentiment in the last few months, some signs that major corporates are just dusting off some plans that they've had on hold, and we're starting to see a bit more activity coming through, particularly amongst the technology and the energy sectors, not surprisingly less so amongst those markets that are dominated by government and state enterprises. From an investment perspective, again, that caution meaning that investor activity is very much focused at the prime end of the market and in those key markets where in some cases we're seeing some rental growth starting to come through. But generally, investor sentiment, if anything, has actually softened a little over the course of the last couple of quarters. And again, this is all related to political and economic uncertainty. Turning to what we're seeing here in Asia, this chart, the bars here show net absorption, the change in occupied office space across the region. The line is the vacancy rate. And you can see that there was a real dip towards the tail end of last year in the amount of net absorption. That's actually picked up again, somewhat contrary to the sentiment that we see certainly coming through from multinationals who they haven't stopped their activity, but certainly they're being quite cautious about any big investment plans. But domestic companies, particularly in India and China, domestic companies tending to just be a bit more aggressive. In fact, we've been seeing one area where Asia really is different to the rest of the world is the amount of construction activity. And there's a lot of construction coming through in the pipeline to hit the market from pretty much now onwards. It started this quarter. And that's had two impacts. Firstly, as we expected, the vacancy rate just starting to tick up because that new supply, a lot of it hitting the market and not yet let. But also in some markets where there hasn't been as much good quality space available, in fact, that's also stimulated some leasing activity. So I think the upturn in what looks like an upturn in occupier sentiment, we would certainly treat with some caution at the moment. Clearly, we're in a better place than in many other parts of the world, but nevertheless, sentiment in the occupier markets here in Asia is still somewhat fragile, although we are clearly still seeing some activity.